So has the stock market actually bottomed, or is this just another bear market rally? In this video, I want to share with you guys some very important data that shows us the state and severity of the stock market correction to understand why I think we are near the bottom, or we have already bottomed. Either case, I'm still a buyer of stocks, but I still think it's important to understand whether or not we're in a bad or a good situation right now. But as usual, guys, before you get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. The first thing I want to address is the fact that in July of 2022, we have had the best month for the S&P 500 since November of 2020. Now, the reason why this is significant is because back in November, we actually had the election time and massive amounts of stimulus with basically no inflation. So it's pretty remarkable that we are now seeing the S&P 500 rally over 9.9% in 1 month, which just goes to show you that we could be very close to that bottom that many people have not been expecting yet. Many people still expect the market to continue to go lower. And although there could be a lot of scenarios where that could be the case, if Russia-Ukraine situation gets worse, or if the CPI print all of a sudden goes above 11% and the Fed's actions don't take place, then yes, there's a lot more downside left for stocks. But as far as all the news that's been priced into the market so far, chances are we have already bottomed. And I know some people will disagree with that, and some people on Twitter especially will think that I am completely idiotic to make that kind of prediction. But the reality is that most people will not turn bullish after the market's already hit all-time highs. And I don't want to be one of those persons. I want to be the one that bets on the market going up when the market's either sideways or going down. And as you can see, the economy is already starting to show signs that it's already priced in most of the interest rate hikes, even after what people would call a disastrous GDP report, which puts us in a basically official recession. Mortgage rates actually fell from around 6% to 5.22% on the 30-year. Now, the reason why this is a good thing is because this will help ease out some of the consumer sentiment pressures that we've been seeing, which has caused a lot of people to sell stocks, especially in the consumer discretionary pace. And as you can see, on a longer term perspective, if you just want to look at what the stock market's doing and not pay attention to the economy, we're going through 2008 kind of levels of correction here. Now, yes, on a number basis, this correction only was around 22%, whereas the 2008 crash was around 50% top to bottom. It still goes to show that we are only around halfway there to the 2008 crash. Meanwhile, we're not having halfway there worth of economic problems. I mean, if I am employed and if most of the people around me are still employed, it means that the economy is still fine. And if people are spending money like crazy and able to afford high gas prices, which is something a lot of people surprisingly are able to do, then the economy is nowhere near the bad situation that it was in back in 2008. So in my opinion, the market doesn't deserve to be all the way down to 2008 low levels. And so even a 22% decline in the S&P 500 is pretty impressive and shows us that you're getting some pretty good deals in this kind of market. Here's another chart that shows us a comparison to the 1962 bear market bottom and where the stock market is right now. As you can see, overall the pattern for a bottom is pretty simple. Essentially, you see this capitulation move at the very start, which puts in this low. And then you see this fake out bear market rally followed by another sell-off. And it's in this sell-off where most of the money is made. You have a lot of people that keep shorting and shorting down here and keep predicting that we're going to break this prior low and continue to go down. But the reality is that is exactly what the people are trying to do. The people behind the stock market or the regular emotions in the market are trying to trap the folks that are shorting down here. And that essentially marks the bottom. And in some cases, often we also see this level break and people eat the stop losses underneath that area before the market continues to go higher. And so if you update this chart for 2022, you can see that we're already kind of in this stage right now for the 1962 chart, because obviously we just had this massive rally. So yes, there could be a little bit more of a pullback left in the stock market, but that doesn't mean you stop buying stocks. You still want to be a net investor in this kind of market, especially if you're near retirement, because you don't get 20 to 30% drawdowns in the overall markets for that long. As you can see, bear markets like these tend to precede recessions. They're not a leading indicator of a recession. They tend to precede recessions, meaning technically speaking, the recession is already here. And the stock market fell in January to predict the recession that we're in right now. And so even though the recession has been confirmed with the GDP data that came out last week, the market rallied because obviously they realized that this was already priced in by all the sellers that were selling at the start of the year. And as you can see, the median drop for bear markets is around 22.7%. And that's over the past 100 years. And guess what? That is precisely the around about area that we just hit for the bottom on the S&P 500, around 3,600. And so for me, that's a good sign. This tells us that overall the upside for the market going to the end of the year, bar nothing changes with the Fed, is pretty good. And that's why I'm a net buyer of stocks, even in this tricky kind of market environment. And as you can see, the reality is that growth stocks tend to always lead the rally out of the bear market. And I've already showed you that the XBI ETF, which is the biotech ETF, and the IWM index, which is a small cap index, have already rallied significantly. Even if you look at my portfolio of Nikola Motors, Plug Power, Bloom Energy, those stocks have actually outperformed a lot of other stocks over the past 2 to 3 weeks specifically. And for me, that was a leading indicator telling me that at some point the S&P 500 is going to catch up. And that's exactly what we saw happen with the S&P 500. As you can see, we bottomed in June, and now we're rallying all the way to 41.30. I didn't predict this really, but I did kind of predict this when I did mention the fact that the leading risk asset indicators had already bottomed. Now, sure, if those leading assets start going down, then yes, that could be another signal. There could be more pain ahead. But in my opinion, those will continue to go up as long as inflation stays on its current path and as long as consumer sentiment stays stable. If either one of those things change, then yes, my bullish thesis will change. But again, that will not necessarily mean that I will stop buying stocks. It just means that I'll be more selective with the companies I buy and maybe be less aggressive with the amount of cash I invest every week. But the bottom line for me is, guys, in this video, I want to reaffirm you that you want to be a net buyer, guys, during these kinds of markets. Don't listen to the media. All these idiots on Twitter are trying to get you to sell stocks because they are not confident enough to invest in the market. They themselves don't have the knowledge base or the effort to think for themselves to be able to invest in the market, especially when valuations are so low. This right here is a chart of the software valuations in the S&P 500. As you can see, compared to even the lows of 2020, we are significantly lower right now. You tell me, are these companies you're buying, let's say like C3AI, Microsoft, Apple, Google, are these companies better off than they were at the lows of March of 2020? I would argue significantly better off. And so for me, this is a good chance to buy the dip on these companies, even though many people will think some of them are scams and some of them are still very overvalued. Yes, some of them were, like Roku and Teladoc, right? Those companies got seriously pumped high to ridiculous valuations. But during this massive decline that we've seen, it's those kinds of companies that get filtered out. And so if you're in a company that even through this massive decline over the past 6 months has not been filtered out or has not gone bankrupt, then chances are you bought a good company. And chances are you will be rewarded if you're patient enough. And I'm already starting to see that in my own portfolio in companies that I held all the way from November. And I'm down like 50-40% on them. And my thesis hasn't changed. And meanwhile, you have somebody like Cathie Wood who's out here selling stocks that she apparently had a pretty high conviction in. She sold Coinbase at basically 52-week lows, which just goes to show you that not everybody is built for this kind of market. Now, there's probably a couple of reasons why she sold. Maybe she wants to reallocate her portfolio, or maybe she was forced to sell because of a margin call. Who knows? But if Cathie Wood is selling, it's a good sign that you probably want to be buying. Because when Cathie Wood was buying, everybody else was selling. And so the reality is she's a pretty good contrarian indicator and a potential sign of that capitulation that many people have been talking about. As for what is the situation of the S&P 500 from a technical perspective, well, guys, as you can see, this clearly is a sign of a bottom because we have broken out of this trend line that we had been making since the start of the year. Now, sure, we could come down and break below that, and then basically that would be a false breakout. But as for now, this has confirmed the bottom. And the reality is the bottom has already happened at a pretty good level right near this 200-week moving average. And if you guys remember, about a month and a half ago, I made a video that went over the IWM index. Now, this is a small cap index. This tracks all the companies that I personally invest in. So this is actually what I should be paying attention to. If you guys remember, I specifically mentioned that this index came down to this specific area just a few weeks ago back in June, and that probably was going to be the bottom. And the reason why I thought that is because, as you can see, that was right where the market broke out from back in November 2020, and that's also this area right here of prior resistance, around that 170 area. Now, we went a little bit below that, but that's how the market works. The market's designed to eat the stop losses right before a low and then rocket higher. It's going to trap all the people that shorted down here, and then it's going to go to all-time highs. And that's essentially the way this market has worked. So for me, in the short term, this is the stock market bottom. And the key thing to keep in mind is that we're still not anywhere near all-time highs. So you still have pretty good chances to buy the dip on your favorite companies, even though stocks are up from their lows. Just make sure to not go all in at once, and make sure you consistently diversify your portfolio. But as usual, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below whether or not you guys think this is the bottom or not. I personally think a lot of signs are going in our favor as long as a lot of the inflationary indicators stay put.